Well, the conflict in the Middle East has had a wide-ranging impact on the commodities market. And it's not just supplies of oil and natural gas being disrupted. Joining us now to discuss what it means for base metals like copper is Craig Hutchison, Director for Equity Research with TD Cowen. And for full disclosure on the companies covered by TD Cowen, please see the link at the end of this video. Craig, great to have you on the show again.
Yeah, thanks for having me back.
All right, so let's talk about the Middle East and the impact it's having on base metals mining space. What are you seeing there?
Yeah, volatile times we live in. Obviously, the war is having a major impact on energy supply. Energy supply is critical for global growth. So if you constrain that supply or the prices go up, as we've seen at the pump, and I'm sure everyone's experiencing it, that's going to be a headwind to global growth. At the same time, there are other factors. I'm sure what we can talk about is some of the other impacts to supply itself. Sulfuric acid has been constrained. That's a major input to the extraction of copper. There's been a few operations in the Middle East that also been constrained. The Middle East is not a major producer of copper. Iran has some small mines. But overall, there have been some offsetting factors that have kind of helped the market be a little bit balanced in this current environment.
What about diesel? What's the sensitivity there?
Yeah, so we put out a piece on Friday, our Q1 preview, and we surveyed all the companies that we covered and asked them the question, what's the impact in the current price environment? And by and large, most of the companies have assumed between $60 and $80 WTI or Brent at the start of the year. So every $10 move in the diesel price, or the oil price, I should say, has about a 2 to 5 cent impact on the cost structure. It depends on where the mines are located. Depends on the type of mine. So for example, Capstone, which has open pit mines, which as you can imagine, rely heavily on diesel for the movement of trucks and shovels. They're probably looking at somewhere around 3 cents a pound for every $10 move. But on average, you're probably looking at today's prices, maybe about a 10 to 15 cent impact on cash costs. There are some offsetting factors as well. Most of the companies produce some precious metals, whether it's gold or silver, and the precious metal prices have obviously moved very high. And for the most part, guys are assuming around $3,900 per ounce gold prices, and today we're sitting at $4,700, $4,800 an ounce. So those benefits from the higher revenues in gold and silver will actually offset a lot of the impact on diesel, but it definitely is a cost headwind.
Now, obviously, with higher prices, it's going to have an impact on the global economy, and of course, global growth. So, how will those headwinds for global growth impact the supply and demand for copper?
Yeah, so we rely heavily on Wood Mackenzie, which is a subscription we pay for, which follows the industry, and they've reset their expectations already to reflect the higher energy prices. So, going into the war, they're expecting around 2.6% demand growth. Now they've ratcheted that down to around 2.2%. So on their numbers, we have, I would say, a fairly balanced market. It's about a 300-ton deficit, which in the context of around a 27 million ton market is fairly balanced, but slightly on the deficit side. Interesting, and maybe we could talk about just the Ivanhoe situation as well. There have been some disruptions on the supply side, which have actually impacted the numbers further. So it's actually made the market a little bit tighter. I think the market's probably closer to 400,000 tons of deficit at this point.
Okay, so given that backdrop, what's the health of the miners right now, and what are you expecting in the upcoming earnings season?
Yeah, so Q1 I think is going to be a softer quarter. Just there's seasonal factors that drive the lower production this quarter. We saw very similar seasonality in 2025. So seasonality can be weather-related impacts. Obviously, we've had a tough winter here in the Northeast, so guys who have operations kind of in the northern climates have experienced a lot of snow, and that impacts production. Grade profiles, Q1 for whatever reason this year round and similar to last year has lower grades, and as you get into higher grades, you get higher production. Other factors would just include ramp-ups. There's Teck has their QB mine that's getting better and better every day. Capstone had a strike, and they have one of their biggest mines is ramping up as well. So you'll see stronger production throughout the year, but going into Q1, I think it'll be the softest quarter from a production standpoint, but at the same time, we're also record quarter like copper prices and gold prices in the quarter. So earnings should be strong. Balance sheets for most of the producers are all in good shape. We've gone through a period here of nice earnings for the last couple of years, so no one's in a liquidity crisis. But we'll see stronger, I think, earnings and production growth as we kind of come out of Q1.